Hi, and welcome to Ahead of the Curve, a dedicated series for money management in partnership with MFS Investment Management, which is designed to arm financial advisors with useful insights on investing in fixed income. Over the course of this series, we'll explore common questions that advisors may have about investing in fixed income and look to provide you with some answers. Whether that's because you're looking to better understand the asset class, help your clients understand the asset class better, or just gather some practical takeaways, this series should be able to help you with that. Our goal is to make fixed income more accessible, stimulating, and actionable for advisors at all levels. In our first episode, we're here with James Langlands, Managing Director and Head of Wholesale Distribution at MFS Investment Management, and with Ron Mehmet, Senior Asset Consultant at Evidentia Group. They're going to be bringing their thoughts on fund selection, and Ron's experience at Evidentia will help advisors understand what they should be looking for in a fixed income fund when selecting the right product for their clients. Let's get started.
Welcome, Ron. Good to see you.
You too, thank you.
Ron, this is the first part in a series that we're doing, an educational series on fixed income.
Mm-hmm. Yep.
Some people might say it's a dry topic. I know that's not my view. I know it's not your view.
Absolutely not.
And public fixed income has probably been in the shade a little bit in recent times, just given a lot of attention we've seen on private debt. Obviously, the equity market's been performing amazingly well. But I wanted to touch on today with you the important role that public fixed income does play and can play in diversified portfolios. And we're delighted that you could join us, Ron, because I know you've spent a lot of time researching fixed income.
Yep.
You've obviously had the privilege of meeting a lot of people, portfolio managers over a number of years that run a range of different strategies. And you also spend time with clients talking about fixed income, be that advice firms or investment committees. So we thought you were an ideal person to have a chat to, and maybe that's a good starting point today, is those conversations with clients. So are there some common threads to the conversations that you have with advice clients on fixed income? As I said, maybe that's a good point to start.
There is a lot of clients and advisors see it as quite complex.
Yep.
And as a result, the education level out there is quite varied. Some people know it better than others, and others really struggle with it. And the ones that struggle with it go, it's a bit all too hard, I'll stick with term deposits or simple cash type products and sort of stay away from it. But I try to educate and help them a little bit and explain where the bond market fits in, because the bond market is an offset to the equity market, more so because it provides that ballast for when things change from time to time in the equity market. So I see myself as a bit of an educator out there, and also to give them a bit more confidence to put client monies into bonds, because the bonds provide that regular income, provide that stability and ballast, as I said, compared to equities, where it's more growth type compared to income type, which you need in a multi-asset portfolio. So giving them that confidence, then they will consider bond funds, which there's many varied types. And again, that's an explanation for them. Some of them are a bit, may I say, scared because of what happened in 2022, post-COVID, when they saw an absolute negative return. But I try to explain to them that in terms of equities, you usually, as the experts say, it happens about once every 5 years you get a negative return on that. And supposedly the theory is once every 10 years you get a negative return in bond funds. But in actual reality, it's actually every 14 years, because I've done the research on it.
Yep.
The first time I remember was 1980 with Paul Volcker. He took the Fed funds rate up to 20%. And we had as a result, we had a negative return in bonds.
Yep.
Would you believe 14 years later, we had the 1994 bond market meltdown, again, an inflation scare. Rates kicked up. It was about negative 8% in bond funds for 1 year. But what happens after that is the yields get so high, the monetary policy that's done by central banks dampens activity, next thing you know, people are switching from equities across to bonds, and then the bonds rally. So when you look over rolling 3 or 5 years, when you get that 1 year negative return, it's disappeared.
Yeah.
And so when financial planners and clients are putting a 5-year plan together, you don't actually see that negative return that's occurred. Just from 1994, if you go another 14 years, bang, it comes into the GFC, which was a credit crisis. And again, it was 1 year of negative return. And would you believe if you go another 14 years, you come up to our favoured date in 2022 when we had that negative return.
Yeah.
Now, that one was quite severe, around negative 12% for global bonds for 1 year, because we were coming off a low base.
Yes.
You know, the Fed took the cash rates really low, down to almost zero. Even in Australia, we had the RBA down at 0.1%.
Yes.
But then they took it all the way back up to 5.25%, 5.5%. And when you're coming off bonds that had been at around 1%, and we had actually a number of countries, particularly in Europe and Japan, with negative bond yields, which had never been seen for hundreds of years, negative bond yields. So to come from below 1% and negative to where the bond yields are these days, of course you're going to get an absolute return. But people got to remember, with bonds, which are very different to equities, you don't actually lose money unless you actually redeem from that point of view. So it's only a paper loss. So when you're looking at a 5-year plan for a client, bonds go back to par.
Yeah.
So the average of global bonds, the maturity is around 6.5 years as per the benchmark. So the bonds will turn over and they eventually go back to par, of course, unless they default. But in global bonds, particularly in the investment grade area, it's very rare to see any defaults. It's more in the riskier below investment grade bonds. So as a result, where they were buying around COVID, bonds which were effectively 99 cents in the dollar, and in cases they were buying them up to 105 and 107 cents above par in the dollar, at maturity, like a term deposit, it comes back to par, 100 cents in the dollar, and you pick up your regular income at intervals of 6 months or 3 months from your coupon.
Yep.
So, yes, there has been a negative return, which has been a turn-off for some investors, but they've got to understand it only happens at times when the central banks are jacking up interest rates because they may have an inflation problem or there's some other issue that's happened and they need to tighten monetary policy, and it impacts bonds for a short period of time. Once the hiking is over, people pile into bonds because then bonds settle down, they come back down over time, and you're picking up a slow capital gain as well as that regular income.
Yeah, and it's something we talk about with clients. Starting points do matter, and obviously that starting point was very low in 2022, not the case today, so it is a more attractive environment for bonds, we'd argue now.
Absolutely. Because of the heightened level of where bonds have been just in recent time, so the returns are much, much better now.
Yes.
You're picking up all that was missing before. But you've also seen the increase now in other areas that are trying to facilitate, like we've seen private debt. Private debt's become very popular, as well as your normal global bonds. And people say to me, well, why should I buy global bonds if they're single digits, where there's some of the private debt is in the high single digits and
early double digits.
And double digits, some of them. And that, again, is an explanation to them from the credit side of, look, if you're going to get yields like that, there's a lot more credit risk involved. So generally, the global bonds are investment grade. They're pretty safe and secure. It's more senior debt, government guaranteed in a lot of cases.
Yes.
But when you're talking private debt, as it says, it's private, it's commercial, it's corporate. There needs specialist people to have a certain amount of expertise to measure the amount of risk you're taking to get those type of yields. So there's a bit of a difference, and yes, you can put them both together in a portfolio as part of diversification. But then it comes to experts like ourselves and specialists who measure up on the risk profile for those clients and for those advisors who tell us what the risk profile is of their clients and what term or period of time their clients want to be in, which is typically a 5-year plan, to measure how much to put in of whether it's private or public in a portfolio from a risk-adjusted point of view.
So they have a place alongside each other in the portfolio. Just be aware of the credit risk that you're taking.
Exactly. Exactly. The good thing about global bonds is that there's many levers to pull, particularly if you've got a manager that can do interest rate risk, can do credit risk,
Yes.
can go into different subsectors, because unlike equities, there are many facets in bonds.
Yes.
You've got government bonds, you've got corporate bonds, you've got emerging market bonds. You also have in there what's called securitization. Securitization is bundles of home loans, car loans, asset-backed.
Yes.
So there's a whole variety of different types of debt securities and instruments which are at the hands of a bond manager to lever and get the better returns on a risk-adjusted basis and diversify risk across a portfolio. It also is a manager can look at down the capital structure of a company. So I'll just say take a bank like Commonwealth Bank, Commonwealth Bank of Australia and here. I'll use that as an example. They have senior debt, they've got covered bonds, which are AAA secured. They have junior debt, they have subordinated debt, and that's all coming down the capital structure. And as you come down the capital structure, the CommBank doesn't have one credit rating. It has a credit rating depending on where the level of the risk is as you go closer and closer down to Commonwealth Bank shares. As you know, hybrids have been very popular with clients. Some bond managers put some of those in portfolios, but you've got to remember that that's pretty close to equities. And as a result, it's got about a 0.7 correlation. So you get a lot of equity type volatility.
Yes.
And if you're putting together a bond portfolio and a multi-asset portfolio, you've got to be cognizant of the fact that you've got your equities on one side, giving you equity volatility, but you've got to watch on your bond side that you don't have also too much equity type volatility, and you've actually got a truer bond. So whenever there's a correction in the equity market, your bonds are going to be the ballast that holds you up and does the opposite and gives you the positive return, because some people put a bit too much equity type volatility and they end up on their bond side having returns that are almost similar to the equity side, and they don't get that negative correlation and one offsetting the other, which is something to watch out for.
Yeah, no, it's a really good point. And particularly, I think, given how well risk assets have done more recently, people might be maybe not have that as front of mind as much as they might have done in the past.
Yep.
Hey, Ron, what about some other observations just from client conversations, maybe some common misconceptions or pitfalls that people fall into when thinking about fixed income?
The typical one is between active and passive managers.
Right.
There's a lot of material out there, and quite rightly it's accurate. They talk about the S&P 500 and active equity managers, saying 85% of them haven't outperformed the S&P 500 index over 5 and 10 and longer periods of time, years.
Yes.
And most of them underperform. So a lot of people have put passive strategies in. However, it's actually the exact opposite on the bond side.
Right.
Because there's so many levers to pull, and because passive indexes are whoever issues the most debt ends up being a greater portion of the index, so the passive guys are replicating the index.
Yes.
You end up with in absolute terms, a lower quality in the index, because the active managers can go after the better bonds, the better quality ones, and they can avoid the ones that are pretty shaky and the fundamentals don't stack up. As a result, if you look long term, active managers generally, over 60% of them have outperformed passive managers.
Yeah.
And in fact, if you look at global bonds and the global ag, which is investment grade, it's about 75% of managers, as of December last year, have outperformed passive managers over the longer term.
Yeah, okay.
So it's a very different picture
Yep.
because of the complexity and the makeup of fixed income, that they can outperform passive managers compared to what happens on the equity side.
Yeah, okay. So it doesn't necessarily follow. Yeah.
That's right.
Yeah, okay. Interesting. And what about the sort of diversification angle for fixed income and what that brings to portfolios?
Yeah, as I touched on, global bond managers have a lot more tools and a lot more areas that they can invest in.
Yep.
So if one particular area is not doing great, they can ferret out basically other areas. So you've got as I said, you've got your global government bonds. You've got emerging markets, so many countries that it pick from. So you'll have at times some countries might be hiking rates and others are lowering rates. And if you're a bond manager, you want to be in those ones that are lowering rates so you can pick up the capital gain. Others have quite high interest rates, and so they're good. And those rates may stay up there for quite a period of time, so there's a good income yield pickup from them.
Yeah, okay.
Also, as I said before, you had securitized, the ability to pick on those. You can go into different parts of the structure. So there's many levers that can be pulled by an active bond manager, including on interest rates. People only think about rates going up and down, but there's also the shape of the yield curve. And active managers have got the ability of, do we go mostly in the short-term bonds or do we go into the long-term bonds? Because they have things like the yield curve might normally shows yields at the end are lower in the short end, but in the long end they're much higher because it's a risk of being in there longer term.
Yes.
So you get paid a higher yield from them.
Yes.
Now, when central banks are changing monetary policy up or down, those yield curves change depending on economic fundamentals, depending on the actions of the central banks. And so fund managers can take advantage of that by loading up in the portfolio either to be in longer term bonds because they're going to come down because they think the central bank's cutting, or they might load up in the shorter term bonds if they're concerned that rates are going higher as a protection hedge measure.
Yep.
So there's different ways of looking at that. There's also inflation-linked bonds for protection that can be put in portfolios. So there's quite a variety of bonds, quite a variety of instruments, and quite a variety of different tactical positioning that can be done by bond managers
Yes.
to add value to client portfolios, which is quite very different to what equity managers do. Alongside that, on the corporate side, you've got teams of analysts like you do on the equity side that are trying to pick the bonds that are going to perform better over time. And that means some bonds might be below investment grade or a lower rating by Moody's, Standard & Poor's and Fitch, and they could be close to getting an upgrade. So they're trying to pick ones that might be getting an upgrade, and also at the same time avoiding those companies that their balance sheets are deteriorating like they do on the equity side, and they may be loading up with more debt. So they're concerned about the overall debt levels and a deterioration in their balance sheets.
Yes.
So they do typically a lot of things that the equity guys do when they're looking at corporate bonds.
Yep.
And corporate bonds trade at a spread because of the risk from corporates compared to governments above governments generally.
Yep.
So there's the angle of trading between how much do I put government, how much do I put corporates in, how much do I put of the other type of facets in. If there's the fundamentals are deteriorating for a country, like their balance of payments might be going into deficit, or their government borrowings are increasing because their budget's in deficit, they can also have the ability to look at other countries as well.
Yep.
And go somewhere else where the fundamentals are better.
Yeah. So there's a whole range of different individual products. Could be high yield strategies, could be
Yep.
emerging market debt strategies. One of the common questions I've gotten in the past, Ron, is just around multi-sector fixed income products and how advisors tell the difference, because there's a range, right? There's unconstrained funds all the
Yes.
way down to more benchmark aware strategies. So what would your advice be there?
Again, it's depending on the risk profile of your client and
Yes.
what their outlook is, and are they after income, or if they're after capital gain, or
Yes.
if they're quite conservative and are quite concerned about short-term negative returns, like we talked about 2022.
Yes.
There's managers out there that look compare themselves against the benchmark, the
Yes.
global one, which is
Yep.
the global ag, or there's managers which are absolute return.
Yep.
And they have a more shorter-term focus, those managers.
Yep.
And what they're trying to do is not give you in the shorter term an absolute negative return. So they're focused more on bonds and securities that have got a pretty high yield. And if any of those bonds prices come down, at least you've got a very good buffer.
Yes.
So it's more absolute return. So it just depends whether your client's an accumulator or transition to retirement, or if they're in retirement.
Yes.
And how comfortable they are with the level of risk, whether they take a fund manager who's absolute return, or one that's more benchmark focused, which takes in a broader range of instruments that they can use.
Got it. And so for advisors out there, keep an eye on the tracking error range that a strategy is looking to manage
Yep.
to is probably the key thing to be looking at, as well as what the underlying exposures are.
Yeah, the tracking error is more consistent on the fixed income side compared to the equity side.
Yeah.
But again, as you said, you've got to look at what type of tracking error compared to the benchmark. whereas the guys who are more absolute return are not as concerned as much about tracking error because they normally base themselves off the cash rate.
Yeah, okay. Got it. Ron, maybe we've talked about the different types of fixed income product. Maybe just bring it back as well. Public fixed income, what are the benefits? And you've touched on some of them in terms of what it brings to a portfolio, being that ballast to a portfolio. What are some of the other benefits of public fixed income?
Yeah, public fixed income is pretty well known because of the amount of analysts that can analyse the actual securities, and plus the information is readily available to investors and unit holders.
Yes.
So they got a good understanding from the fact sheets that the fund managers put out of what's in there. You know, how much government bonds, what type of government bonds, what type of corporate bonds, what type of RMBS or home loans that they put in those portfolios. Yep. So the information is publicly available. It's liquid. It's daily priced. So you can see the movements in the bond fund. You are receiving regular income out of those coupons, whether it's monthly or quarterly, and it's pretty safe stuff because the active guys have picked the eyes out of the market.
Yep.
Yes, the passive guys are just replicating the market, and when we talk about that, replication is they're matching the index, so they don't have any relative risk. But they have absolute risk because, as we said, actually once every 14 years, there is a negative return in fixed income, and the passive ones will do an absolute negative return. Yes, the active guys will try and counter that, and they do, and usually significantly outperform, but they might have a smaller negative just for that particular year compared to the passive guys. Now,
yes.
When you compare that to the private debt side, it's more opaque there. It's not daily priced.
Yes.
Liquidity depends on when they open and close the funds to get in.
Yep.
It could be yearly, it could be 6 monthly. They're priced whenever the loans are repriced. Some of them are monthly, quarterly, or even yearly, those loans, and you don't know what's in the portfolios. It's not displayed because it's private, because a lot of those loans that are in the private debt side have got clauses in the bank loans that they're confidential. They're not to be publicly available.
Yes.
So at times you just don't know what's in there. You can see the yield and you can see the return, and you think that there's no volatility in there because the price of those loans don't change unless there's a corporate debt event, like someone misses a payment.
Yes.
Until then, you don't know what's going on in those portfolios, and that's why because so many people have invested in them. There is a lot of people now calling for more transparency on the private debt side, but as I said, on the public side, you've got all that.
Yep.
Day to day. It's all there for you. You know exactly what you're invested in. You're getting your income. You can get in and out each day pretty much. The only time where it gets a bit difficult is when we get those extreme financial market events, and maybe the buy-sell spread widens for a period of time until the volatility settles down.
Yep.
But when that happens, usually on the private side, those funds don't trade at all, or you can't get in or out.
No, yeah. Advice, Ron, for advisors out there that are looking at different fixed income managers, what should they be looking for in a public fixed income manager?
Yeah, in public fixed income managers, you should have a manager that's got a track record, that's been through a number of interest rate cycles. So they're quite experienced, they know how to handle it, and they know exactly what type of strategies to put in place to enhance returns for clients.
Yep.
So those type of managers, and also that they've got teams that are quite varied in their skill set. So they know emerging markets, they know credit, they know interest rate strategies, they know asset-backed securities. So they know what levers to pull and what to highlight, and from a risk management point of view, to know what to avoid. So with all those multitude of tools in the basket, a public manager with a long track record, with a big team, would give you a lot more comfortable as a core addition on the fixed income side. Plus, because they've got so many varied tools, they're also at the coalface. Yes. So when there are events that happen on the geopolitical side or changes from central bank governors, those guys can act in these days where the information is instant. They will act instantly on your portfolios. Whereas for you to react, or your financial planner or advisor to react, means over a number of days doing a redemption, waiting for 5 days for that redemption to go through, and then going into the other strategy. By then, if there's a correction in or volatility in markets, it could be all over in 2 weeks.
Yeah.
And then you're back to things settling down again, because whatever the event was has happened so fast. So we're used to historically seeing events happen over weeks and months. These days, people notice that when there's volatility or some geopolitical event, it all happens within several weeks. So my suggestion is allow the active fund manager at the coalface to do the work for you. So with all the tools that they've got, so you can rest easy that you know that they'll take the appropriate actions for your portfolios, rather than you have to physically go and move your money from one strategy or fund manager to another fund manager or strategy.
Makes sense.
Let the fund managers do the work for you.
Well, thanks very much, Ron. That was a great starting point for this series that we're running on educating people about fixed income. I love the conversation around the conversations that you're having with clients about fixed income. I thought it was really interesting, the anecdotes about active fixed income too, and the fact that it's on average outperformed benchmarks quite considerably. So that's something that perhaps people wouldn't be as aware of. And also just talking about the benefits, which, as I mentioned at the outset, public fixed income's kind of been in the shade. So some of those important benefits that I think people should be aware of in terms of the diversification benefits it can bring to portfolios, but also just the breadth of opportunities that public fixed income managers have at their disposal. So I thought that was great. Thanks very much.
Thank you.
Thanks, James. Thanks, Ron. That's been some really insightful comments that I'm sure will be useful for all our listeners. In the coming months, we'll be diving deeper into global fixed income markets, exploring opportunities for Australian investors, and discussing why public fixed income can offer compelling benefits for your portfolios. Expect actionable strategies, expert perspectives, and plenty of thought-provoking discussion to help you stay ahead of the curve.